The big elephant in the room, let's talk about it. The stock market is on track to have 3 negative red weeks in a row, and this is after a historic run. 18 of 22 weeks green. We're talking about the S&P 500 here specifically. So why is this happening? Well, in my last couple of videos, I referenced that the bond market has already signaled that it knows the Fed is not actually going to cut rates. Remember that there were 6 rate cuts priced in for 2024, then it went down to 3, and now Bombshell report by the Fed, or Bombshell, I guess, commentary by the Fed, is that Bostic reiterates what Powell has said the last couple of weeks, that a rate cut is not likely until the end of the year. And then the Fed Beige Book came out yesterday. I'm recording this on April 18th, so this came out on April 17th, talking about referencing the little progress that has been done to reduce inflation, even though economic growth remains steady. But we all know that this is typically what happens before recessions, is that the economy runs so hot. So the problem is not getting in strong numbers, right? You typically have low unemployment, extremely high priced housing, higher than average wage growth, etc. The problem is not with tracking good numbers. The problem is when the numbers get so hot that inflation is out of control, and now the Fed has to step in with their blunt tool instruments and try to control inflation. The only problem with that is that typically leads to a recession. So let's talk about the market here. What am I expecting for the market upcoming? Is this the beginning of a bear market? Is this the beginning of a market crash? Or is this just a little pullback here? And what is the Fed signaling now? There is definitely a change in commentary by the Fed about the expectations of a rate cut. And not only that, there was another piece of bombshell data by the Fed themselves. This is by the New York Fed. I want you to take a look at this. What does this look like to you? This is supposed to be the bank reserves of the Fed, aka their balance sheet. So not only now are they projecting that the Fed is going to slow quantitative tightening in 2025, right? And no word on if this is based on whether the fight for inflation has already been won, but they are likely to add assets on their balance sheet once again. Now, if you've been following this channel, you know that I've actually given the Fed credit for this, for rolling assets off of the balance sheet. The $4.5 trillion or so that we added after the pandemic, I've actually given the Fed credit for rolling off $1.5 trillion of that new money created, but I also was very skeptical that they would stick with it. Because why? Because in 2019, the Fed actually tried to do this. Actually, let me take a look at the market real quick and show you what I'm talking about. So before the pandemic, the Fed actually tried to roll off assets off the balance sheet. And what happened? The market started crashing. This is this right here. The market started crashing. We almost had a bear market. And then the Fed said, no, just kidding. We're not doing it. If you look at the Fed's balance sheet, you'll see this right here. You'll see that in 2019, right here, this little trough here, if you can even call it that, it looks like a little skateboard ramp. This right here was the Fed attempting to roll assets off the balance sheet. And then the market started crashing. And then at the time, the president at the time, Trump, was attacking Jerome Powell, threatening him. And the Fed then said, no, we're just kidding. They actually did an interest rate cut then too, as well as added assets onto the balance sheet. And then we had the pandemic where we added trillions of, in my view, unnecessary dollars to the balance sheet. So with that said, we're already seeing that, as I've said before, the reason that I'm skeptical is because I saw that after the financial crisis, the 2008 financial crisis, and the Fed added assets to the balance sheet, there was ample time during the Obama years where we had the biggest bull market in history because money was cheap. There was ample time to start rolling assets off the balance sheet. There was ample time to raise rates to a healthy rate. But the Fed, the corporations, the government, everyone was addicted to easy money. And so we didn't. And so I think this is just going to become the modus operandi, just like other things in our financial system. You can look at, for instance, the deficit, right? The government has no problem now keeping a deficit. The debt ceiling, we have zero intention of ever bringing the debt ceiling down. As a matter of fact, since the debt ceiling was established, the debt ceiling has never come down. So what does this mean for the market? What does this mean for your portfolio? Let me dissect what I think is going to happen in the market. And just a quick break to tell you, if you are watching this before April 21st, make sure that you sign up for our free trading mastermind. This is live. This is not recorded. I'm going to be hosting it. I'm going to be teaching it. We usually go for an hour and a half, 2 hours on these masterminds. So it's going to be April 21st at noon Eastern. Make sure you sign up. Link is in the description below. First 1,000 people that sign up get in absolutely free. I'll see you guys there. As I told you before, the bond market is a much, much better predictor of what is going to happen, right? Because the bond market is inextricably tied to rates. The stock market doesn't really give a shit. The stock market is just like growth, 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 growth. And if there's something that's really troubling, you guys will let us know. But usually by that time, it's a little bit too late. However, I'm going to tell you why, if there is something brewing, historically, we have actually had time to get out, and I'm going to tell you when that time is. So I did a video a month ago in which, a month and a half ago, this video right here, in which I was lambasted for saying that I'm getting uncomfortable with the stock market at this level and I want to sell. And I started selling assets that I acquired during the bear market, during the correction of 2023 as well. I started selling some of those assets, and I said the only thing I'm interested here are things that are still cheap, not QQQ, not the SPY, but things that are so devalued that they are already cheap, and I'm taking a less risk by investing in them as opposed to investing in something that is very highly priced, right? So, it's funny, I was lambasted, and now the stock market has lost all of its March gains and is now dipping into its February gains. So it's even lower than when I did that video. Now, we could still get a rally. Let me talk about this right now, what I think is going to happen. So if we take a look at the chart, historically, these blow off tops that create all-time highs, right? As you see here, as you saw in 2020, as you saw in 2018, as you saw in 2015, we come back to retest the previous high. So in this case, for the SPY, the previous high is at 475, somewhere around there. So I think it's very plausible for the market to hit that 475 range, in my opinion. Now, we could get bounces from here. I'm not saying we're going to go straight down to 475. As a matter of fact, there are imbalances here where the market can bounce from, right, in the interim. And then, either trade sideways, come back down. I'm not dictating how it is we're going to get there. I'm just saying that is a plausible level for us to test at some point, right? And I want you guys to keep things in perspective. It's important to note that not every pullback, not every correction is a bear market. It's not a reason to panic. But the reason that I'm uncomfortable here is not because of the stock market. It's really because of what's going on with the bond market. So if we take a look at the 10-year, the 10-year dropped to 3.5, actually less than that. The 10-year dropped to 3.25. It is now on its way to 5 once again. The bond market signaling a ton of fear here. And, brought on by the fact that the Fed cannot cut rates, as the Fed is now signaling, brought on by the fact that the longer that the Feds keep these rates higher, there could be something in the economy that will end up breaking. And as I said before, I'm, keeping my eye on commercial real estate as one of those things. So, it is because of the bond market. It is because of all of these other recessionary things that I brought up to you guys time and time again. So if you take a look at the median sales price of a house sold, right? This is now declining precipitously from 480,000 to 417,000 in the United States. And I mentioned that before recessions, we tend to see dips in housing prices, just like we saw here. If we take a look at something like the wage growth tracker, as I said before recessions, you tend to see a decline in wage growth, which we are seeing now. Obviously, the yield curves are still heavily inverted. And like I said, between the 10-year and the 3-month, and here between the 10-year and the 2-year, once this uninverts, and we are seeing the 10-year on a surge right now, the 10-year is on a surge as economic data continues to come in strong, and the narrative is that the Fed cannot cut rates, right? So when this uninverts, then I think we will be super close to declaring a recession, right? We will be within weeks to months of declaring a recession. Now, keep in mind that we also have earnings coming up. So as of the time of this recording, Netflix reported earnings. Now, Netflix did well on earnings, but we all know that the stock market is forward looking. So the stock market wasn't looking for good earnings. The stock market was actually obviously looking at guidance. How is Netflix and how are other companies going to navigate in a high rate environment? And you can see here that Netflix is down 5% after hours, even though they beat revenue and they beat earnings, but it's because their guidance showed a declining revenue, right? And obviously this is just one company, but I'm saying that if this becomes a trend with Tesla, with Apple, if this becomes a trend, then I think, I'm comfortable saying that this is likely the top of the stock market for 2024. If the guidance from Apple doesn't report guidance, but if the guidance from other companies such as Meta, Alphabet, Amazon, Tesla, if the guidance is not favorable and the guidance mentions that in a high interest rate environment, we are expecting less growth, we are expecting less if it pertains to the company, less subscribers, we're expecting less sales, less earnings, because it is hard to operate in that environment, then I honestly think that this is the top for the 2024 stock market. If the guidance is decent, then I think the market can actually bounce from here and keep on trucking until something breaks, because as I stated before, the Fed is now saying that they are likely not going to cut rates until the end of the year. And they're also admitting now that they are making very little progress on reducing inflation. And one other thing I'm monitoring heavily, as I told you, which is a pre-recessionary indicator, is the fact that gold and other commodities such as oil are surging. Gold is actually outpacing the stock market. This is something historic. But what's even more interesting to me is the disparity between gold and bonds. This right here is the 10-year bond, right? Not the 10-year bond yield, the 10-year bond price, which moves inverse to yields. So historically, gold and bonds moved side by side. They moved together. But when the correlation, right, this right here is the correlation coefficient down here. When the correlation turns negative, this is usually something that happens. Let me switch to the monthly. This is usually something that happens before a recession. We saw this in 2006, 2007. We also saw this in 2015 when we had a double dip correction, right? And we are seeing this now. So, and we saw this before 2011, where we had an almost bear market as well coming out of the great financial crisis. So right now, we are in negative correlation between gold and bonds, which historically doesn't signal, right? It signals a flight to safety into gold, and it signals that bond traders are demanding a higher yield for bonds because they are expecting turmoil in the markets and in the economy. So like I said, I started offloading stocks a month and a half ago, and the only thing I'm invested in are things that are cheaply valued, right? But I would likely start opening up protective puts if we retrace back up into this 508, 509 level on the SPY. Obviously, I will be tracking earnings, and I will be monitoring the situation, seeing how many companies are actually missing guidance. I don't really care about earnings themselves, and the market really cares about, what's coming up in the future. So I will likely start opening up protective puts now that we broke structure. If we retrace back up to these imbalances, in order to, stick with the thesis that we are likely going to test this previous high that we saw in October through December of 2021, right here, that 475 level. As I said, I'm not saying it's going to be a straight shot down for me. I monitor this stuff day to day. It's important not to try to trade off of videos. Things change all the time. This is something that annoys the living piss out of me, is that I'll make a video and then people treat it like a day trade without getting any updates, without, hearing my updated perspective. I do obviously post on Twitter and on Instagram daily. So follow me on Twitter and on Instagram for free trading and finance content daily. But don't trade off of my videos or anybody else's. I'm giving you an idea of what I'm going to do. Obviously, all of my real-time stuff is posted in the Discord. I posted a weekly analysis update today on where I think the market is going to go. And I continue to post what I think from a macro perspective on the market, as well as day trades. So if you want, follow us down below and you will get my everyday thoughts on where I think the market is going to go, my exact entries, etc. But as a general sense, I'm going to be waiting for a retracement to ride it down to further levels below. I don't think yet that this is a bear market, as I said before, but if companies come in and start missing guidance and talk about how this new high rate environment is a challenge for them, then I think we saw near the top for 2024, in my opinion. And before you guys tell me, some of you guys tell me, oh, we've never seen a recession in an election year, right? I get this comment all the time. I don't know who these people are that comment this. 2000? No. 2008? No. 2020? As a matter of fact, the last 3 recessions were in election years. So I don't know where this comes from, right? Or the fact that the Fed is going to cut because it's an election year. Okay, go back and look at election years. The Fed has had more rate hikes during election years than rate cuts. So again, something that is unfounded. I get the skepticism between the government and the Fed, and I share that skepticism, but it's important to look at data. Anyway, these are my thoughts. Oh, one other thing. Make sure that you sign up to the free mastermind if you're watching this before April 21st. I'm doing a free trading mastermind again. The first 1,000 people that sign up get in there for free. So make sure that you sign up, reserve your spot April 21st at noon EST. Anyway, leave your comments down below. Would love to hear from you. If you want to join the Academy, link is in the description below. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.